Hi, everybody. How are all my trading warrior brothers and sisters doing today? Hi, Alexander, Didier. Guess Zoom is having some issues. Just so you know, hi, Sinatra. Just so you know that if you don't get your daily, Hugo, how are you? You don't get your daily invite email from Zoom, you could use an old one. I I found out today. Okay. So, okay. Um, dollar index. I'll say something about the dollar index here, low Forex gal. I always have a hard time believing in the bear case of the dollar when leadership is cable, which looks like right now we just made a new high. Okay. And look at that 4 hours diverging, 2 hours diverging. 15 minutes is still confirming. But anyway, um, you're getting a decent pop in euro. Euro looks okay. And the Dixie, this could have just been a failing rally up here at 91. I think we'll know right around this area. I don't think we should close back under 90.40. So that's something to keep in mind. And looking at something that is different, I am Zig, Little Ponce. This is different today. And, you know, this to me looked pretty impulsive, even though we had a confirmed low. And, this looks like we're, still correcting. And when's the last time you saw gold up and silver down? It's been a while. So, be careful with that. All the news is saying there's going to be a squeeze in the March silver contract delivery starting, I believe, next week. Delivery notices start to go out. But anyway, this is different where you have gold that actually up now $7 and you still have silver down on the day. So what that means if you get a continuation of that is that gold is now your preferred long for a while silver is your preferred short. S&P's covered yesterday, so came off this line. I just continued it off and some of you here in the room were talking about that we could have one more high in the S&Ps, and that still is possible. So far, we failed up here, which was unchanged on the week. Up here, we closed at 40 last Friday. But if we get back above 30, you can make the case for getting new highs. A lot of people looking at resistance at 39.50. But when you look at this, it still is possible that we get a new high. If that happens, a 4 hour won't even peek its head above a 70 RSI reading. Okay, and um, we're going to most likely now get the new high in Aussie. It's taking its time to do it, but when you look at the daily, now we're 40 pips away. 78.20 is a high. It's not going to confirm on um, a lot of different time frames. And someone asked me to look at Euro Aussie the other day, and it was starting to look interesting here. We're starting to get some daily divergence and 4 hour divergence. It's grinding. And if we get back above 56, I think there's a shot for 59 on that. Um, I think that's about it. The only problem I have with what's happening with the dollar is I prefer to see euro leading the way instead of cable. Okay, and but that hasn't happened for a long time because of this, right? And we're making new lows right here on the EG. Not much divergence, a little bit here. So that's what's going to have to change is the direction of EG. Looks like it tried to put in a pin bar right here, so maybe that's about to change. I don't know if I didn't have any view on the dollar. Um, this is starting to look interesting to me in the pound. I don't know. I'm going to ask Blake where he has resistance or what he thinks. He probably has some numbers up here, fib extension. So that's a perfect segue. What do you think of the pound up here, Blake? Making new highs.
I just had my coffee in my mouth.
Oh, sorry, buddy.
Taking a sip of my coffee. It doesn't surprise me. I'm pretty bullish. The sterling,
Okay.
and I have been. If you watch the week ahead video this last weekend, I'm just like pound crosses, pound
Yeah.
dollar.
Yeah.
The biggest issue that I have with it right at the moment is that relative strength is divergent, and the
Okay.
140 level is going to be a big psychological barrier.
So
I was
just
actually
psychological. You don't have any fib extensions up here or anything like that, right?
no, but I should probably take a closer look at this point, and
Yeah.
and you'll notice here. Let me go ahead and grab the screen really quick.
Okay.
Give me just a second here.
Blake,
Yes.
as you're doing that, mate, good morning, first of all.
Good morning.
Good morning, Steve.
You didn't get today an email, Dale, right?
Right.
No one
Yeah,
did.
yeah, I didn't either. Just to reiterate, the emails go out from Zoom. The other day, they obviously had some problem with the mail servers because all the emails of reminders and notifications came in the
From
middle of the night for
Texas.
me.
Oh, maybe
They
they're in
came in the
Texas.
Yeah, so they were queued up and they came in the middle of the night. So I'm assuming that these days they have some outages with their mail servers, and unfortunately there is nothing we can do. But
Yep.
as Dale said, A, you can use a previous email. B, um, you can just
You can
use
bookmark
the.
it.
You can also bookmark it, yes, and
Mhm.
three, you can use the widget if you've logged into Forex Analytics from a computer. Doesn't matter what kind of computer. There is a widget on top. You can use that
Right
to
here.
join. Yeah.
Oh,
Yeah. And if you're in the chat room, I put a picture of that, this little widget here. You can see this button. It says join. You just click it. That's what Steve's talking about.
okay. Thank you, Steve.
Thanks, Steve. Yeah, and the best thing is just save an email of the link that you get,
Yeah.
or bookmark it so you don't miss it. I used to bookmark it as well previously, and I have now. I just kind of save a couple emails. I have one for my login for when I'm hosting the for these webinars, and then the daily roundup and that type of thing. So thanks, Steve. Appreciate your input. So Dale, we were talking about the sterling and the cable rallying. So the next big, like, you can see this is I guess you want to say the last big move lower, right? It's right here. You can see that the high back in August. This is as we were Brexit negotiations, and that dip all the way down to 126. 161% extension comes in just basically at 140. So I mean, we're almost there. I'd be a little more reserved trying to pick up the sterling at these prices. I'm not saying that it can't go higher. I think it can. I actually think it can against a lot of the crosses. I think the pound's going to be very well supported on dips. So let's say the euro drops to 119, and the pound probably will drop to 138 or 137. I don't really see it pulling back too much. 137.50, if you guys don't recall, that was the big breakout point here. And so I was hoping we'd get back down there again. Actually, overnight, I was kind of hoping we get back down there. I'm not playing the pound US dollar long. I'm playing the pound crosses long. So like, if you guys are not following the, you know, pound Aussie, them long this, and I actually was the edge chart of the day, or I said edge chart is the chart of the day from 2 days ago. The pound New Zealand long, that it's approaching the 200-day moving average. So, and if you look at the euro pound was actually the chart of the day from yesterday, as we're dropping towards the 161% extension. So remember, those can be found on our website if you just go to blog. I try to blog one every day, well, every trading day. Plus we have some other blog posts that'll get put out there, especially if we have some big ideas. Right now, we're not full of big ideas. Oops, that did it because I just logged back on. I don't know. Did you hear that? Did you hear Amanda's voice?
I heard it.
Yeah, that happens whenever you log back on. It tells you that, hey, the webinar is broadcasting. Anyway, it's interesting. No one has a lot of big ideas in the market. I mean, you could say, yields are going higher, inflation starting to turn up, but those are all knowns. And other than that, it's like, okay, well, stocks are going higher, so what do? Well, you just play the old stocks higher, dollar weaker, commodity stronger card. And I mean, we've been playing that so long. It's like, okay, well, but believe me, when we start getting some volatility and you start seeing a little bit more up and down in the market and range bound type of activity, we'll have a lot of better ideas, I'm sure, pop up on the blogs when that happens, but you'll hear about it here first. So anyway, that's my idea with the sterling. I think it's pretty bullish, but we are, approaching some, that 140 level is going to be a big number no matter what. And I wouldn't be surprised if we pushed above it by, 30 or 40 pips and then came off again. I would be very hesitant about trying to short the pound dollar. But if you're playing some of the pound crosses, you might just take that into consideration, that we're moving into some pretty key resistance at this point. So
thank you, buddy.
Yeah. So anyway, that's how I feel there. So Dale, actually, before I go into this, I want to talk about Bitcoin, because Bitcoin continues to strengthen. There is no let up in Bitcoin right now. We are currently, we have what Dale, you call a throwover, right?
Yeah.
Currently, we are over the previous channel, but that doesn't make it bearish. And I have to say that Bitcoin pullbacks have been very minor. So whenever you get price action like that, Dale, how do you feel, when you get like just minor pullbacks?
Well, back inside the formation, that throwover, the way you play him is you just wait for him to get inside, and then that's your signal.
Yeah, but if we're not pulling back very much after a prolonged move higher, it's also,
I tell you, I don't have the courage to short, to even trade it. Okay, to trade it. So, but that, if you just cover up the title, and that could be anything, that's how you play. That's how I play a throwover. I let it do what it wants to do above the wedge line, and then back inside. Then it's a possible failure. Possible.
That's all right. Well, and that's a good recommendation, especially when you're talking about Bitcoin. Yeah, just forget it even says Bitcoin up there. It's just we're trading above that channel, unless we dip back below, like I would say even 50,000. While we're above 50,000, probably no sense in trying to short it. Now we've had this really massive move in yields this last week, and you can see that the 10-year yield is starting to perk back up again. That is something that I'm paying attention to, because the dollar is weak right now, but when yields start to move higher like this, again, does it get the market's attention? Does it start to turn, uh, uh, turn the focus back to equities? And remember, equities are a little weak right now. And if equities start to, when I say a little weak, they're just, we are at all-time highs. But if they start actually pulling back a little bit because yields are moving higher, that might get the attention of the dollar. And that's when the dollar might actually firm up a little bit. But I do want to point out something that I tweeted yesterday, which was Apple. Apple's not, it is not it's not, I don't tend to, look at it a whole lot. I just don't. But I did yesterday because I did realize it was breaking through this solid uptrend that we've been in since COVID started. Well, since the COVID spiked down, and the recovery. Yeah, we are below this trend line. You can see pre-market, we're trading at 129.
Yeah.
It's down almost $2. This is the world's largest company, and it's actually starting to trade heavy. So if that's going to happen, what's going to happen to the dollar here, or equities rather? Can equities continue, lower if the largest company in the United States is and in the world is starting to press lower? I think you got to be a little careful, right?
Yeah, and in fact, what would be a great market tell would be for the Dow and the S&Ps to make a new high without the NASDAQ. That would be a very interesting event that would tell you, that the market's topped, because if the leader can't make new highs with everything else.
Yeah. So if you've got what, and I have to point out, the Dow almost hit all-time highs overnight. Like the continuous, like the futures contract. This is basically an ETN, but it's basically tracking futures. We hit the 88% retracement and we've rolled over again. And so I think you have to be a little careful that we're making lower highs in the Dow, the S&P also lower highs, and possibly a head and shoulder pattern here. Everybody should know that this is 3870 is by far the most important support for me as far as equities go. And then NASDAQ also, look, I mean,
heavier. It's a heaviest.
Heavier, right, Dale? Yeah. That's right. Yeah. And again, I'm going to point this out. I think we can draw it with the S&P too. And I'm not saying that we should break down right at this moment, but this is not symmetrical, but head and shoulders don't have to be. It's nice when they are, it definitely is nice when they are symmetrical, but doesn't mean it has to be. One of the things that is kind of concerning me too is this variant with COVID. Gosh, I'm so COVID fatigued right now. I don't even want to talk about it, but it's something that, when Pfizer last night recognized that this COVID variant could really mess up the efficacy of all of these, all the vaccines. That's not good.
Pfizer said that. I heard that yesterday afternoon. Oh, okay, because I heard on the news that it was effective against the South African. Not, it doesn't have the same efficacy, but that it was effective. But I don't know, we're getting different news.
I think there's some, it was the CEO yesterday had mentioned it, but I'll have to go back and look, see if I can find that.
Yeah, they're already talking about a booster.
Yeah. You know what? I'm gonna let Steve and Stelios come in and take over, and let me look for that headline for you. Second.
Also today we have John Nettle with us, and John was written about by Jack Schwager. He's one of the unknown market wizards, and last time John was here he said buy the beans, and they exploded. So looking forward to talking to an unknown, now a very well-known market wizard.
Yes, it's going to be an exciting interview today. I've been meaning to follow John. Actually, I'll just follow him on Twitter here. I've been meaning to follow him.
Yeah, well, you guys were both. He was a Marine too.
Yeah. Hey.
Yeah.
I love a fellow devil dog, that's for sure. So,
All right.
Steve Stelios, good morning, guys.
Good morning, mate.
Good
Hey,
morning.
I'm gonna let you guys take over because I'm gonna see if I can get the I can get the article about or the headline about Pfizer. I'll come back on that. Oh wait,
Okay.
hold on. Here we go. Oh, I'm sorry. No, that was J&J.
Pfizer's weaker. than
I'll chime in later. Okay.
Okay, buddy.
All right, guys.
Good luck today, Blake.
Thanks, you too.
Hello, everybody. How you doing?
Hey, Stel.
Hi, Stel.
Hey, Dale.
Good.
Hey.
Good.
Steve.
Looking forward to the interview. So, a couple of things to mention. We had the ECB minutes of the January meeting, and we got a few little things to note that they talked about. I think for me, the most important one is they said that we shouldn't mistake temporary inflation boost as sustainable. So they don't believe that oil going to $60+ is gonna create any more permanent inflation and everything that's associated. Allow me to disagree, but obviously it's something it remains to be seen. They also said that the General Council members widely agreed that there's no room for complacency. They must continue to stand ready to use everything available, blah, blah, blah. So really, same with the Fed, same with ECB. They're just going to keep the pedal to the metal. And unless inflation or the way they measure it, goes above target and stays above target, there's no way they're going to do it.
For an undefined period of time.
Yes. It's symmetrical now, yes.
Yeah, because they haven't defined it. Yeah.
So we've been below for what, 5 years now, and maybe we stay above 5 years. I mean, I don't know. I'm obviously joking, but
they will keep moving the goalposts as needed, Stelio, as they've been doing.
Yeah.
Hey guys,
because I remind you.
Oh, I'm sorry. I hate to interrupt it. Just
of course,
Simon, pass it over here. Pfizer vaccine being much less effective against South African variant of COVID-19. This is out yesterday. Laboratory studies suggest the South African variant of the coronavirus may reduce antibody protection from the Pfizer vaccine by 2/3.
Wow,
that's a lot. Anyway. The study found that the vaccine was still able to neutralize the virus, and there's not yet evidence from trials in people that the variant reduces vaccine protection, the company said. So it's just, those variants are. Anyway, I just needed to throw that in there. I'm sorry to interrupt. I'll see you guys in a bit. All right.
Absolutely.
A couple of other things from the ECB. They mentioned that there's reasons to be cautiously optimistic about the recovery, but also that the current estimates for the growth forecast might be too optimistic. And they did mention the euro exchange rate again. And, they keep mentioning it as long as it's above 120. It's been the same story for years now, above 120 in euro dollar. And they're going to start mentioning and, talking about it, which shows that they're concerned about it, and rightly so. So that was from the ECB.
Race to the bottom.
Yeah, as I said before, they're not gonna stop. Gonna keep going, and the question is, does the ECB and the Fed go to where the Bank of Japan has gone? Are they going to start buying equity ETFs?
Of course.
Are they going to start buying? Are they going to buy all of the debt? It's
of course.
Yeah, it's we laugh about it, but every day.
No. I'm very serious about it. I think next crisis, and by crisis I don't necessarily mean like a COVID thing, which might take years to happen, right?
Yeah.
I mean, even next like big stock market rout. I mean, they've anyhow proved that they don't care about their mandates, because nothing they've been doing is within their mandates. It's actually against their mandates. So what they've been doing to bypass that is they're building facilities that do things for them. Which, it's not really surprising, because I remind you that the Fed and the rest of the central banks were, for example, if we want to talk about the Fed in the US, it was created to bypass the constitutional limitation about creating money. So in the same way now the Fed creates facilities to bypass its congressional mandate on what it can and what it can do. So once you go through the red line of doing that, yeah, what stops you from buying stocks as well? I think it's a matter of when, not if, Stelio.
And look at things like the debt ceiling, which was made precisely for that reason, to limit how much the government can borrow, and they just move the posts again. So you're absolutely right, and it is scary, and it just shows that forever, I mean, unless something drastically changes, which I don't see it, forever the value of money is going to, the purchasing power of the dollar, of the pound, of the euro will just keep going lower and lower. That's why you see the people who know and the people who the wealthy, really wealthy people, they just pile onto any real assets they can get.
Yes, anything. Because their price adjusts to the actual value of money. That's why.
Exactly.
Yeah, absolutely. Yeah, that's the case.
Sums it up.
Undoubtedly. It's politicians have always had like two options: the honest option of either limiting government spending or taxing people for all the government spending they want to do, but taxation is already too high, so nobody wants to take the political cost of raising it even further. And then the second option, the dishonest one, which is taxing them the indirect way by diminishing their purchasing power. And guess what? That's what they've chosen to do.
Yeah, indeed. Yes, otherwise it's been pretty slow. The bonds are the ones, the thing I'm still looking at. And for people who have been following, I'm still short bonds.
Treasuries have also broken down from 61.8 in this channel.
And talking about bonds, the ECB actually did mention
and the Bund
rising. Yes, they did mention yields going higher are going to be a big risk for equities. Good, because they pay them the big bucks to say that. But yes, they are right on that. And we've said this for months, maybe years. There's only so long you can keep yields artificially low for. At some point, risk will have to reprice.
And I've explained before, Stelio, why for one bubble to exist, meaning the stock market bubble, the other bubble is also necessary to exist, the bond market bubble, and vice versa, right? Because if bonds are not at these ridiculous valuations and they don't yield nothing or negative, then stocks immediately become less attractive at current valuations. So one bubble necessitates the other bubble to keep existing.
Actually, the biggest bubble coming into and after COVID was in the bond market. If you pull up TLT, you'll see that we're almost back at the levels, one of the only markets back at the levels of the COVID crash when the Fed came in. Pull up the weekly and you'll see what I'm talking about. It really, the weekly will show it.
Testing channels.
Where's that? Okay. Well, anyway, you can see in March where the Fed came in. Mm-hmm. We're almost back there. Hardly any markets are back near the levels of last spring. Mm-hmm. So actually, everyone went. It was already a well-loved market. It's a bigger market than equities, and that expression, Steve, don't fight the Fed, caveat, except if it's in the Treasury bond market.
Mm-hmm. Yeah, in general, the expression "don't fight the Fed" is a right one, because we've witnessed for like 12 plus years how painful it is to fight the Fed. So I've said it before with Stelios. I think there is an easy trade to do that fundamentally is also easy to devote yourself to, that helps you go in the same direction with the Fed, and that's being long precious metals. Because in essence, by being long precious metals, you're not fighting the Fed, you're with the Fed. I mean, you're in essence saying, yeah, I believe that they're actually going to achieve what they're trying to achieve, right? So, I want to be long precious metals.
Okay, I guess
Yes,
Jane.
By the way, we just got some data. Philly Fed manufacturing 23.1 versus 20 expected. Initial jobless claims worse than expected at 861 versus 765. Also, the previous one revised higher by 55,000. So the labor market is doing worse for another month. Housing starts worse than expected. Building permits, though, better. And US continuous jobless claims worse than expected. So we're seeing again some weakness in the employment market never returned to where it was. That's the only certain thing. But we're seeing now a worsening. We had seen a period of improvement in initial jobless claims, etc., and now we've seen that trend starting to reverse. And if that accelerates, that is going to put a huge dent to all the rhetoric about possible recovery or whatever.
Yeah. Okay, let's bring our guest on.
Okay, are we ready for the interview?
I'd like to, but I don't see John in the house. John, are you registered under a different name? And I just sent him a message on Twitter, and he responded this morning that he was looking forward to it, but he is not here.
I don't see
Okay,
him.
we can go ahead and cover a few more things until he shows up. So yeah, the TLT is interesting, Dale, but as I said before, look where we found support for the time being. Obviously, a break below this trend line is going to be, a very bearish development.
Wasn't DSI single digits the other day on bonds? I think it was 10 or 9. So,
I don't remember.
Now people are bearish. Now they are.
And here's the 10-year yield as well, which has broken higher from this channel. And here is the 30-year one, which remains in a larger channel though, but it has broken through this important resistance area at 190. So let's see if that actually can become something more, because for the time being we're seeing this push higher, but it's slow, methodical, and orderly for the time being. I think that the big trouble will start for the Fed and the rest of the central banks if this move becomes disorderly. For the time being, that's not the case. For the time being.
But there is pretty good disintermediation between the market going up and yields going up at the same time.
It's another gap that has to close at some point, right?
Yes, yeah.
I mean, we've seen several of those happen and several divergences starting to develop. Add that to the list. Usually that's how turns take place.
That's how crashes take place in '87.
Yeah, exactly. You start seeing one by one different markets deviate and diverge, and to begin with, nobody cares about it. You know what I mean? Right. I mean, they're like, okay, there's some divergence there. Yeah, then there's another market.
Still low.
Then there is another market. Then there is another market. Then there is another market.
And suddenly, a tipping point.
Yeah, and suddenly, exactly, there is a tipping point.
Oh, John's here now.
That investors wake up to the reality that, wait a second, so many instruments here are trying to tell us something. Perhaps we should listen. Okay, so John is here, you said, right?
Yes, John just got here.
Okay. So,
okay, John.
Enjoy this interesting interview, and for the rest of you, in 40 minutes, you know where you'll find us. Now, if the email doesn't come again because they seem to have an outage, as I said, Blake is going to put the or Stelios is going to put the link in the chat room. Okay. Enjoy
Thank
the
you,
interview,
guys.
Dale.
All right, John, waiting for you to unmute. Welcome back to Face.
It's great to be here. Can you hear me?
Got you, John. Yeah.
Okay, awesome.
Great bean call last time, John. I mean, on your way out, you said buy beans, and they were really a moonshot. Led all commodity markets as far as performance on the upside. So very nice call.
If it starts with thank you. If it starts with a B, buy it. I guess Bitcoin and beans. Can you
Oh,
go
okay.
wrong?
I didn't think about that. So are you going to be sharing your screen today?
No, unfortunately, I got some tech issues, so I'm just talking on my iPhone.
Okay.
And
All right,
that's why I was
that's
late. I
fine.
spent 15 minutes trying to get my laptop to work, and it just didn't. So
All right.
it is
Well,
what it is. Yeah.
maybe I'll take us around the horn, John. And
Sure.
John, I was curious. I wanted to know, what was your reaction when Jack Schwager reached out to you and said he wanted to put you in his book, Unknown Market Wizards?
A tremendous sense of honor and humbleness. Obviously Jack's an iconic author.
Yeah.
And in our industry, and to be even considered with that pantheon of great money managers and traders, just the consideration and the thought is honestly like kind of bigger than me.
Yeah.
It's too much.
Yeah.
It's kind of intense.
Yeah. So, because you probably read all his previous books, and then all of a sudden he's writing about you. So what was really your breakthrough? I know in the book it talks about you really becoming more of a system type trader where you kind of automated your ideas. Was that the big breakthrough for you?
I think we should qualify that, Dale, just briefly. So I'm a person that trades very discretionary, but on top of a systemic, an automated process, if you will. That sounds probably a little jumbled, but here's what I mean by that. I go about my business and have a process in place, but there's still very much discretionary aspect, or I allow myself some of that discretionary leeway. I think the breakthrough was establishing processes around a narrative to complement the technical analysis that I use. So I'm
okay.
Like I appreciate, purely automated trading strategies, and they have their role. But what I tried to articulate in Market Wizards was that, in much more expansively in the Global Macro Edge, the book I wrote like 5 years ago, that took 5 years to write, is that it's about leveraging those strategies and gearing up and gearing down based on the regime that we're in. Okay. So if we're in a regime that's conducive to a certain type of trading strategy, then you want to leverage up those or gear up the exposure to that strategy. Conversely, or correspondingly, if we're in a regime that's not so conducive, then you want to lever down those strategies. Okay. And so naturally, I mean, if you just run every strategy at a 1x, okay, or 1x leverage,
right,
all the time, well, you're going to go through regimes where it's, they'll work out, they won't work out. And okay, here's sort of I'm going to try and benefit from certain diversification properties. But if I understand that right now, let's go back to the bean call, that we're in a reflationary market environment, and now I'm looking to play momentum strategies. Okay, so let me analyze what aspects of this regime, i.e., expanding gamma, okay, market repricing, inflation expectations that are out there, or increasing, accelerating inflation expectations, or factually accelerating just inflation in and of itself. Now what I want to do with a beam strategy. Okay, now what I want to do with a breakout in certain commodities, like let's take oil, for example. Let's take Bitcoin, for example. All right. If you understand the macro narrative and you gear your strategies around that regime or that macro narrative, okay, you can take, and this is the main point I kind of try to convey, you can take what are very cool opportunities and leverage them up. So instead of being 1.5x or 2x, and then you throw in optionality and trade structure around that, you create some really nice things. And all of this sort of descended from kind of a bottom up approach where as weird as it sounds, I used to be very just economic trader. I talk about in the chapter about how I built this proprietary trading software, called Impact, and it effectively, can read and process things in sub-millisecond time. And I'll spend days building contingency models of how I'm going to execute based on certain scenario outcomes, right? And so that is what you look at is effectively kind of like a bottom-up approach. And I think that's, to your point about automating things, right? Because I have this automated outcome based on this one event, but the process of getting understanding those outcomes is a byproduct of sort of everything I had just covered in the last 3 or 4 minutes here.
Okay, what's the definition of protein?
Sure. No, protein comes from, well, let me give you the definition, then I'll give a
Is it
little
Greek?
history.
Greek
Is it,
derivative?
it's a Greek derivative, absolutely. So it means highly
So,
versatile, easily adaptable, and able to take on many shapes and forms.
okay, interesting. All right,
Yeah.
so I knew it probably had a Greek root or derivative
Well,
because
it's from the Greek god Proteus. So
oh,
Poseidon,
okay,
yeah, Poseidon what was the obviously the god of the water, god of the sea, and his
right,
son Proteus obviously took on that same shape, that same water-like form. And for those here in the States or have seen the ESPN 30 for 30 about Bruce Lee, you know what I mean? I think it's called Be Water, okay?
right,
And for
right.
all the malleable properties water has. And I came across this word back in 2012. I'd never heard of it before. I didn't know what it meant. You know what I mean? I'm in my late 30s. And I'm like, I see a word. I don't even know what this thing means.
Yeah.
And I'm like, protein. Like, what does protein mean? And I read it and I'm like, highly versatile, easily adaptable, able to take on many shapes and forms. How would I not know what this? This is like the coolest word ever. I love this word, you know? And
I hope someday to be protein instead of cement. I want to be water. So
you me both, sir. You me both, sir. Trust me.
So do you see, there's a lot of talk right now, John, about yields. I was talking about them back in August. I thought the most crowded trade, especially after the COVID crash, was in the bond market. And it's interesting, treasuries are almost back to the level that they were. Here, I'll put up the TLT, where they were when the Fed came in. And, that old expression, don't fight the Fed. I guess there's a caveat, except in the treasury market. See, we're almost right back to this level. This was when the Fed came in. Whereas things like corporate bonds and junk are just starting to roll over. Can you have any explanation for why treasuries, which are supposed to be the quality, right? The flight to quality, why they're under more pressure than junk bonds? Made new highs, I believe, last week, and corporates are finally looking like they might be rolling over. What's your take here on global and U.S. debt markets?
Sure. So let's just take a step back. Great question. Great relative comparison between those two asset class, those two subcomponents of an asset class. Let's keep in mind, like, what is a factor when driving credit quality, or the movement in pricing of credit quality, and that is sort of solvency risk, right? And so let's think about what's at play here. Right? Do you think that the idea of, and we can even take a look at the Russell 2000, the idea of a U.S. recovery, a blistering U.S. recovery, does what for perspective, broad-based, speaking generally, Dale, like, does what for perspective credit quality? Okay, is it a good thing if I'm going to underwrite loans that the economy is starting to expand and these businesses are potentially going to make more money, or is that a bad thing for credit quality? Right, it's a good
recovery.
Thing for
it's good.
Quality. Yeah. Okay, it's a great thing, right? Now let's also sort of like juxtapose that on like the fact that the Fed and the Treasury are now kind of working hand in hand, and that you could end up getting, the vaccination rate of the United States is accelerating. Okay, it is doing. We are going to have. Listen, I'm not a virologist, an epidemiologist, but I'll say this: that we seem to be on a pace. Okay, and the people that I respect and read, that we're going to have, like, by this summer, not like where none of us are going to be wearing masks again, but the vaccination rate in the United States is a reason why, or the success of it, or the prospective success of it, does lend itself to some commodity inflation, which we're seeing in soybeans, which we're seeing in oil, which we're seeing. We're also, let's take a factor here, like, do you think a tough supply chain? Because I think the bigger challenge for, like, and why we saw inflation numbers in the PPI yesterday is the bottleneck in the supply chain. Okay, is that we have the Fed that has explicitly said we're going to let this economy run hot. Okay, I mean, and I can see the Fed coming out talking about, oh, this inflation's transitory, but you're going to hear more and more conversation about supply chain issues impacting inflation. And when you're looking at, like, what crude oil is doing, what soybeans are doing, okay, and the fact that Bitcoin is actually doing what gold is supposed to be doing, okay, you're looking at the gold silver ratio right now near 65, which is down from 80. The gold silver ratio was at 80 back in, like, late November. It's now down at 65. For that kind of a ratio to have that big of a dramatic movement on it, okay, is another sign as well. And so kind of, I guess, going back to sort of Jack Schwager's, your question about the Jack Schwager breakthrough moment, it's understanding these qualitative discretionary narratives and then overlaying them on top of like a technical trading process and being able to say, okay, why is this happening? And so, like, to your point, you asked a great question. Why is the corporate credit is not coming off as much as, sort of like legacy AAA rated government debt? And so I think if we just can deconstruct that sort of like we have, you end up with an answer that satiates that and think, okay, well, let's also keep in mind another factor of like global yields. And that is like, what are Boons doing in Germany? What are gilts doing in the UK? And those ideas, like, well, global fixed income is selling off in general. So it's not just necessarily the sell off in US fixed income is just about the, investment grade debt versus, corporate debt. But you're talking about what are global yields doing, and those are also coming under pressure. And so there's not like sort of relative value trade to come in, which is why I think, man, I hate saying this, or I don't hate saying this is what it is, but I think gold can be like at 1720, 1730, because real yields are going higher. Okay. And I don't think that like people have fully appreciated yet that we can get a legit uptick in inflation. And then you can see the Fed come out and say, yeah, but we're not going to do anything about it. I mean, what's going to happen to 30-year treasuries when the Fed says, listen, we're not going to be raising rates in the next, whatever, blah, blah, blah. I mean, even if the US stimulus doesn't end up being, 1.9 trillion, even at 1.4, like you have a blistering economy. You have vaccine. I mean, the economy is basically 2 shots in the arm from like really just kind of not being back to full normal, but like, man, like there's a lot of gasoline. There's a lot of gasoline out there that can just get lit up. So there you go.
So what do you think, there was, I'm not comparing this to 1987, but you have to say there's some disintermediation between equities, your major indices and what's happened with yields. They, from the bottom in April in equities, rates have tripled on the 10-year. And don't you think that's going to play a role and possibly change the regime in S&Ps? Are you starting to get some signs that this market, especially with what's happening with a lot of blow-off type windfall moves across the board, not just crypto, but marijuana stocks, almost everything you're seeing 5-baggers, penny stock volume off the charts. Do you think that the market's in a precarious situation up here right now? And is it viable for just maybe 10 to 20% correction with what's going on here? Or am I premature like I've been for a while?
Yeah. So I would say my sentiment on that is one of like, and this probably goes to like my personal life. I've had a life sort of advisor, performance shaman, if you call them. I've gone to therapy, you know what I mean, for the last 20 years. And what I've really focused on is kind of like justifiably or attempt to balance sort of the past, the present, and the future, but really with the focus on kind of being present in this moment and being present about what we're doing right now. And sort of having the faith and confidence that I've put in place a process that when a more protracted sell-off emerges, then my 25 plus years of market experience is going to like give me the data and the indications that moment will happen. And it's not everything you're saying is credible as precursors to what a market sell-off can look like. But in this moment, okay, the amount of flows that are there, it really comes down to what is your risk management process? Because that kind of question you're asking now is really, I think, something that like if you're a buy and hold investor and you don't have a credible risk management process in place, then that to me is more concerning. If you have a credible risk management process in place, which is again the global macro edge, I talked about this, maximizing return per unit of risk. If you're going to look at something, you better know what your unit of risk actually is. Is my unit of risk 2% of a portfolio? Is it 10% of a portfolio? What unit of risk will I allocate in terms of to a certain strategy to a manager? All right. And so those factors you mentioned can persist. And I could probably push back and say, not that I like that this is my thesis, but we've never before had this sort of unprecedented level of cooperation between the Fed and the Treasury right now. I mean, we have the former Fed chief running the Treasury, okay? And if you put a gun to my head and said, all right, what are like if you could only take, sort of like if you could only take like 3 things with you that you'd want to have, all right? what would you want to do to effectively define a bull market? I'd want negative real yields. Well, check. I'd want the Fed and the Treasury, working towards. I want fiscal stimulus on my side. I want monetary policy on my side, and I want like an expanding economy and growth multiples, and all those things are present here. Okay, so like I'd ask, I'd say like, if you're not going to buy equities, okay, definitely there's without a doubt, both qualitatively and I think empirically, some real froth out there, and you're referencing that quite viably.
Yeah.
But correspondingly, the other variables there, like, do you really want to not be exposed to a market if you're a money manager? Just put your like $2 billion money manager hat on. Do you not want to be exposed to the market with US vaccines increasing exponentially week over week? Are you going to tell your investors when we're at 42 on the S&P that you weren't exposed as like the Fed and Treasury working together? Are you really going to tell your investors? You're fired, dude. You're effing fired. Okay. Like, you're done. All right. It's defensible to lose money with the aforementioned metrics I just went over. It's not defensible to not make money, especially if you're a real money passive flow kind of guy with those metrics out there. It's just, you're done. Okay. So there's too much career legacy risk with those underlying dynamics. You can't tell your investors, well, I thought it was a little too frothy because of GameStop. You know what I mean? Or I thought it was, I thought with Bitcoin at 52,000 that I couldn't own the S&P 500. You know what I mean? I think it's more about what sectors do you own in that case.
It's about retention. It's about retention, keeping your clients, right?
Completely.
We have a question here from one of our attendees, and I don't know how you feel about it, but I've always believed that the dollar and the foreign exchange market, especially the dollar being the reserve currency, is kind of like the fulcrum of the wheel that all other asset classes spin around. Is the dollar going to continue to be the sacrificial lamb? Because I mean, you could get appreciation in markets because of supply chain, but you could also get nominal gains from a continuing weakening dollar. You have a view on the dollar?
It's not as I do. It's probably not as
everyone's bearish. So I mean,
it's not as self-aggrandizing as about the dollar is the end all be all, or the FX markets are end all be all. I used to sort of carry that view.
Really?
It's about rate differential. Yeah, because here's the deal though. But like, rate differentials now are non-existent in the short term between. Look at the euro, look at the US, look at yen. Everyone's at zero.
Great
so
point.
if you're gonna make the currency argument that like that FX is where it starts, I'm like, insofar as it, like, with rate differentials on short-term yields, basically like at negative 50 bips or negative 25 bips or zero, like it's really tough to, like, that argument. It's a little softer now as what 10 or 15 or 20 years ago. I do think that the fulcrum now though is
central
it's a little more blended. It's a little more blended, I'll just say. Okay. Across equities. And I think that if you want to like look now at like, okay, I mean, the S&P is the king, and the Russell 2000 doing what it is, and now you're seeing like equity markets and fixed income markets of those, like the real reflections of like which country is ahead of the game. And I do think last time we briefly touched on this, that like that what we're going to see in the next 6 months would be like whose supply chains were the most adept, who was the most adept at rolling out vaccines, sort of similar to like a wartime analogy. All right. And so I want to get to that question, that users, that attendee's question about, is the dollar going to be sacrificial lamb? But I think that we first need to understand the prism from which we are evaluating this market right now. And I think that prism is commodity reflation, i.e. the price of oil headed higher. So that's going to put pressure on the dollar, obviously. Okay. We're going to look at, other commodities doing well, domestic growth reflected in like the Russell 2000, I think, and we're looking at tech. We're looking at inflation accelerating. Okay, those are all things that that with the Federal Reserve not going to act. If you have like inflation accelerating in the U.S. and the Fed basically not raising rates, that is also deleterious to the dollar as well. So I think that for factors maybe different than what the question asked, yes, the dollar could go down, but But if the dollar goes from 121, USD is at 121, and in 6 months is at 124. Yawn. Like, that's kind of a yawn situation for me. Like, I just don't like there's just other trades out there, and FX has been kind of a wasteland. And
so it has. Yeah,
It has.
yeah,
So
it
I don't.
has. Well, even though it's our bailiwick, all the action's been elsewhere. It's
Yeah.
all
So that,
been
and
in
that's okay.
equities,
Yeah.
crypto,
Yeah.
marijuana stocks, everywhere
Right.
else but currencies.
Right.
So the
So
central banks took the game away.
they did. No, they put a floor in things, and that's too bad. But at least there's other asset classes to trade, and it's not that there aren't opportunities in
Currency.
those.
Yeah.
You just, again, I'm going to go back to my regime thing. We're in a regime right now that if you have a strategy that trades long optionality in FX, I'll go back to the top of the program. That's not a regime that I want to lever 2 or 3x. That's a strategy that I put at 0.25. Okay, what is it that you do? I buy options. You know what I mean?
Yeah.
I buy options on FX. You know, whatever swing trade setups. Okay, well, FX has been a wasteland. So given the regime, given the narrative, given what's happening, I would take, out of 100 strategies, that one I would create like an implied netto number using a process, and that netto number, the netto number is how I maximize, or it's how I measure the implied return unit of risk, where I say, okay, the higher your netto number, the better you as a manager, the better the market performs on a unit of risk basis. So then I talk about this in chapter 8 about how I use the netto number to effectively imply the profitability of the strategy. Now, that doesn't mean that's what it comes out to, of course, but just having the process of saying, okay, using these metrics and using this, I can measure the implied return per unit of risk on this strategy and then adjust the gearing on that position accordingly.
Okay, and you bring up oil. It's been a moonshot, really, and I think people were scarred, John, seeing it go negative last year. Right? I mean, sometimes I've never seen a commodity go negative. So
neither have I. But you got to come down to this though. And this is where I think you need to learn people need to bring with them a greater degree of temporal granularity. And by temporal granularity, I mean that you understand the time series that's involved in a crude contract. Okay, that what is true for the April contract or the May contract of 2020 is not true for the January contract of 2021. What happened on the negativity there, obviously, is that for that 1 month, for the supply for that 1 month, okay, due to the supply chain shock and due to just a complete halt of the U.S. economy, obviously,
there was no storage.
There was no storage anywhere. I mean, they're put in parking lots. You know what I mean? Barrels in just parking lots and everywhere else. Okay, so you saw a one-off phenomenon that was simply reflective of a lack of supply availability in that 1 month. Okay.
Well, Icon saw that. I heard Icon bought 1 million barrels and said, "Well, we have room. We have some storage space."
No,
at a negative price, he bought it.
I don't even know. I'm sure he just.
That's what I heard. Anyway.
Yeah. Why? I mean, and then you throw in the disruption on the day of when that contract rolls off. I mean, I got to see firsthand how that unfolded, and so yeah. I mean, there you go.
What do you think? I mean, do you do any kind of price projections or just a process?
No, I think crude's at 75. Crude will be at 75 by
by
the end of the year.
You want to leave us, your best idea last time was beans. What's your best idea right now? And if you don't have one, that's okay too.
Yeah, I mean, I think it's a basket of 3 of them. You know what I mean? And I think that we keep playing on this, and so it's February today. So if I come back at the end of the summer, at the end of August, you're looking at S&P at 4,400, 4,350 on the S&P. You're looking at crude at 69.70 for the September contract. If I come back in August, you're looking at I don't know, soybeans at soybeans are a little more idiosyncratic. I don't want to. That soybeans is a different trade, frankly. I think the Russell is trading at 2,500 ish. You're looking at NASDAQ 15,200. Okay, so I mean, you see the broad theme going on here.
Okay, why are you pointing towards August? You must have something in mind for that month.
I'm picking 6 months from now, basically.
Oh, okay, I'm just
picking 6 months. Yeah,
okay.
And so 6 months from now, you're looking at. I think Bitcoin is at 75, 80,000, 75,000 6 months. Yeah.
Oh, okay, so I see that you're designing something here. You're getting ready to open something soon. What are you going to be doing here, Jen?
I am just repurposing the website to make it more interactive and whatever. And frankly, it's one of those. I'll be real with you. I make my money trading.
Right.
And I need to get on this. It's had that thing there for 3 months now, and people are I can't buy the book internationally because I think you can buy it on Kindle, but like I don't know, like I think in the UK even like I'm getting messages saying it's not there. I don't do a very good job of running my book selling business, to be honest with you. I'm kind of a trader. I gotta be more efficient. Yeah,
that's your passion. So, all right, well, John, it was great. Getting your views and perspectives on things, and kind of tempers a few things I was thinking about. And very interesting point. My Steve Volge was talking to me about this, what the central banks have done to the currency markets, and appreciate you. I'll ask people, John, what's your most valuable currency, and people will say gold or euro or yen, and it's really our time. And so I want to thank you for spending your most valuable currency with us this morning.
It's my pleasure. You do a great service for the trading community, Dale. Thank you so much. Call me anytime. It's just a pure honor to be on here. Thank you much, everyone.
I really appreciate it, John, and I'll get a hold of you. I'm thinking about May, so I'll get a hold of you and we'll book something, okay?
Sounds good, sir. Be good, be safe, be healthy, sir.
All right, good hunting. Everyone, John Netto, no longer an unknown market wizard, a known unknown market wizard. We'll see everyone tomorrow. Remember, don't just count your pips, count your blessings. Adios, everyone. And you could join the team for the bias chart and technical talk in about half an hour, I believe, or 15 minutes, right, Steve?
And just a little bit below 15 minutes, yes.
Okay. And that's a wrap, everyone. We'll see everyone tomorrow. Wrap up the week. Adios.